All right. Next in our program is our first keynote address. Avery Shenfeld is Managing Director and Chief Economist at CIBC with a very impressive background. He holds a PhD in economics from Harvard University, a sought-after commentator with a focus on North America. Avery follows economic developments and their implications for financial and asset markets. He is a 6-time winner of the Dow Jones Market Watch Award for Most Accurate Forecaster of the U.S. economy. Most recently, he was recognized as the top forecaster of the Canadian economy by Consensus Economics for 2 consecutive years and was the top-ranked economist in a survey of institutional investors. His prior background includes experience in management consulting, on the economics faculty at the University of Toronto, and lecturing in the summer program at Harvard's John F. Kennedy School of Government. We're looking forward to your insights. So Avery, over to you.
Thanks very much. And thanks everyone for joining me today. It's certainly been a topsy-turvy world. And when I look at the Canadian economy, what I like to say these days is that we're waiting for a shot in the arm. And literally and in both senses of that term, because the economy still needs a shot in the arm to get back to where we were pre-pandemic. And it's going to take a shot in the arm in the form of a vaccine, I think, to cure the remaining ails that we still see in the Canadian economy. This is, of course, a global story. If we look at world GDP this year, it's going to end up having been down around 3.5% because of a missing in action second quarter in particular, when we were at our worst. And to put that in perspective, that's about as big a GDP decline as we ever see in the global numbers. And certainly for Canada, a roughly 5 to 5.5% GDP decline this year, again, marks 2020 as a year that I'm sure, all like to forget, both personally and in terms of the performance of the economy. And the Canadian numbers are actually a bit worse than the US numbers. US GDP maybe end up being down more like 3.5 to 4%. And the difference is really that our energy sector is having a double blow from a excess supply going into this, and then the big downdraft in world oil demand. And the heavier weight of the energy sector in the Canadian economy is a big part of why Canada's actually had a bigger decline this year. We do have a light at the end of the tunnel, and it's not a freight train coming to hit us. It is the vaccine and the likely cure that that will bring for a lot of our economic malaise right now. So we do expect, for example, in Canada, growth next year, somewhere on the order of 4.5%, somewhere in that range. That's going to make up for some, but not all the ground that we lost this year. And remember that in a normal 2-year period, the economy would have advanced by about 3%, maybe 3.5%, and instead we'll have had virtually no growth over that 2-year period. So if you're like the kids in the back of your car seat and asking, when are we there? When are we going to be back to where we want to be? That's really going to be more of a 2022 story, late 2022, before the economy really can return to full health. If we look at our trading partner in the US, a similar story. They may grow at 3.5% next year, but again, that's sort of 2 years of zero growth put together. So they too will have their work cut out for them. The US is, of course, a big part of the Canadian economic story, as always. There are some additional headwinds that we're worried about in the US economy over the next couple of quarters. One is one that we share here in Canada, which is that if we look at the recovery that we've seen since both economies hit their trough in April, it's been one of very mixed success. So the good side of the economy has actually roared back very strongly. If you look at US retail sales, for example, if you look household goods consumption is actually running now above where the trend line would have put it had we never had COVID, which is certainly bizarre. You don't normally think that with unemployment elevated, people are buying more stuff than they would have bought had the pandemic never hit. But if you think about your own behavior, you can actually understand why. If you don't go out to dinner, you have to load up more at groceries. So you substitute some services for goods. You buying computers perhaps for your kids to work at home while you're trying to work at home. Maybe you bought an office chair for your own house, a heater for your backyard. All of that is showing up in quite strong goods consumption in the US and in Canada as well. But there's still a big hole in the US economy, and that's on the service side. And to think about the average consumer, about 2/3 of what you consume is services. And while you're still living in your house and so on, that's considered a service to some extent. You're also not flying the way you used to. You're not going to live sports events, conferences, travel, and so on. So the reality is that we made up all the ground we could have and then some in the kinds of economic opportunities that we're able to reopen while the pandemic is raging. And the remaining hole in the economy is in sectors that are very tough now to make up the missing ground until we get that vaccine. So we would have at this point been expecting a slower pace of growth in the next couple of quarters in the US and Canada. However, there's a second piece to this story, which is if you think about this virus, you know, if this virus could talk, I think it would sound a lot like Arnold Schwarzenegger in The Terminator. And I'll spare you the imitation with the accent, but you know, his tagline was, "I'll be back." And that's what we've seen with past pandemics. And of course, that's what we're seeing now, a very strong second wave of coronavirus hitting Europe, hitting the US, hitting Canada. And we know that governments across Canada and the US are making different decisions about what to open, what to close. But not all of this rests in the hands of those government decision makers. There are studies in the US, for example, that show that states that had comparable experience with the virus and made different timing decisions on when to, for example, reopen activities, didn't really have that much of a difference in terms of consumer behavior. Because when people hear that the virus is raging, they're less likely to want to buy an airplane ticket, even if no government is telling them not to. They're less likely to dine indoors and so on. So the virus itself in both Canada and the US is going to take a little bit off of growth. So we may struggle to grow much for the next quarter or two. And in the US, there's an additional reason that we have some concern, which is that Congress did not approve an extension of the exceptional unemployment benefits that not only gave more dollars to Americans who are unemployed than they normally get, but also covered people who wouldn't normally get unemployment benefits. Very similar to what we did here in Canada, except that in the US, in 2 stages, they've allowed those programs to lapse. So at first, the people who were getting extra benefits, they lost some of that. And now at the end of December, actually, all those extended benefit programs are going to end. And many Americans would have exhausted their regular unemployment benefits. And we'll start to see people kicked out of their houses. And importantly, start to see people not spend in the economy. And so that could certainly create the makings of even a negative first quarter in the US. Now, we're hopeful that Congress will get its act together and reach a compromise on at least a modest and temporary stimulus package that will tide us through the period while we're waiting for the vaccine. So that might happen as early as December, and certainly not much later than late January after the Biden administration takes over. Even if we need Republican votes, I think they'll be there for at least a reasonably sized stimulus package to tide us through. So that's a worry, but I think we'll get through that. But even so, next couple of quarters are going to be a little on the soft side in the US. But once we get through the vaccine period, I'm actually turned quite a bit more optimistic in terms of US growth, and by extension, I'll talk about this Canadian growth, particularly when we look into late 2021 and into 2022. And by the way, in terms of when is the vaccine going to be available, obviously there's been some questions raised on that in Canada, and I don't have all the answers to that. On the US side, I've tended to listen to Anthony Fauci. You all know who he is. He's the celebrity in this situation, rather than Donald Trump, who told us we would all be cured, I suppose, some months ago. And what Fauci has said is that the typical American might be able to roll up their sleeves in April if they're willing, and that he thinks that by the fourth quarter, we might be living mask-free in the US. So think of the timing of mass vaccination as a mid-year story, and the economy really starting to gather momentum in the second half and particularly the fourth quarter of next year. Our view is that that momentum could be very strong, particularly in 2022, because unlike past recessions, the job losses we saw in this recession have been much more concentrated. They really didn't spread across the economy the way they did in the last recession, which was started in mortgages and financial services and the housing market, but spread to general job losses across the economy. We haven't seen as much of that, which means that when we get the cure for what ails the industries that are being held back, that's going to be a big cure for the economy as well. So I think 2022 looks quite bright for the US. Now, in Canada's case, where are we right now? It's a very cup half empty, cup half full story. If you look at where GDP is running at now versus where it was running at just before the pandemic hit, we're still down as much as we would be at the bottom of a normal recession. So we made a nice recovery from the worst days in April, but those days were akin to the Great Depression in terms of the GDP decline. And now we've recovered to where we normally are in the middle of a normal recession. So not great overall. And the drop was bigger in Canada because the energy sector is larger and it's been one of the struggling sectors. And like the US, how the economy is doing is very different depending on which corner of it you look at. So I like to say if I was a cheerleader on the Canadian economy, I'd have my pom-poms there. I'd be saying, give me a V, give me an L, because parts of the Canadian economy, if you look at their economic output, they look like a V. We had a deep decline and then a rebound, and we're pretty much back to where we were, or even in case of home building, we're actually running higher than we were. So some sectors have actually boomed. And, I think Amazon's doing pretty well in Canada, for example. The trucks keep driving by my house. So there are parts of the economy doing great, grocery stores, another sector that's booming. But there are other parts, convention centers, hotels, anything to do with a lot of high-touch person-to-person contact, indoor dining, bars, entertainment centers, all really struggling in this environment, and more like an L where you see a big decline and then really barely any recovery. And since, like the US, that's the sector that we still need to get back in gear, it's now going to be more of a waiting story than a steep recovery for the economy as a whole, because we'll really need the vaccine to get those sectors fully engaged. Until we have it, it's an on-again, off-again story with the waves of coronavirus. That said, governments have taken some very important steps to prevent what was a massive shock from turning into something like the Great Depression, where we were left stuck in a tumbling economy for many years. And the biggest difference in this cycle was how quickly we got money into the hands of both households and, to a significant extent, businesses, to essentially give them a life raft to stay afloat until that vaccine arrived. And we see that in a number of measures that we look at on the economy. We see, for example, that bank accounts have soared. People have a lot of money in the bank because those still working haven't been spending the way they would like to. They've had to cancel their travel plans. They're not dining out. They're not traveling to visit their friends and so on. And so savings are piling up there that represent future spending when all this economic activity is permitted again because the disease has gone away. And we've also helped people who have spent all the money the governments have given them because they've lost their jobs, but we've kept them afloat and therefore prevented what would have been a much larger wave of business and household bankruptcies than we've seen. That's not to say that this isn't a challenging environment for many businesses. And indeed, we are still going to see, I think, some further insolvencies as this extends in through the first half of 2021. So not everything is going to be rescued. Many restaurants, for example, won't live to see the better days to come. But we're kind of keeping the economy together until that vaccine arrives. And that's very important because it means that, again, we'll have some spending power in reserve to help drive this expansion when we get into late next year and into 2022. Some people are very worried about the other side of the ledger in terms of sending out all those checks, which is what's happening to budget balances of the governments and whether or not that means that in our future we have some massive tax hikes to pay for all this. And certainly these are extraordinary times in terms of the scale of the fiscal relief and what it's costing. To put Canada in perspective relative to other countries, there's sort of two sides to this story. We entered this period with one of the lowest debt to GDP ratios at the government level, at least, among the G10 countries. So we were in good shape that we hadn't, like some others, run up huge debts while the times were good. That was the good news for governments. But we are also running one of the biggest budget deficits this year. So we've actually doled out more relief as a share of our economy than some other countries. At this point, I'm actually not that worried so much about the legacy of that. And that's for a couple of reasons. One is that unlike you or I or companies, you don't have to pay that government debt ever. Governments just roll over this debt. We never pay it all back. So the future obligation for taxpayers is not to come up with $350 or $400 billion that the government has borrowed on our behalf this year. It's instead just to cover the interest on that extra, 350, 400 billion, whatever the number turns out to be. And because you're borrowing at 0.5% a year interest rates, even if you borrow for 10 years, the government's been running 10-year rates, not much above 0.5%. That's actually not that big an interest rate bill. You could do the math of what's 0.5% of $400 billion. And if I'm right, that's $20 billion. I'm not that good with numbers. That's why I became an economist. And $20 billion out of a typical year of government spending is $350 billion. It's not nothing, but it's also not huge. And secondly, virtually all the deficit we're seeing now is because of temporary programs that will disappear when COVID is over, as well as a huge hit to government revenues that will disappear when we recover from COVID and government tax revenues go back to normal. So we will be left with a bit of an overhang. I think municipalities are one area where I am worried about some very near-term tax increases. They're not allowed to run year after year deficits. They may have some reserve funds, but they're exhausting those. So we may get something there. But federal taxes needn't go up that much as long as, and this is the big if, the government doesn't start creating a whole bunch of new permanent programs under the guise of, well, we're running a big deficit anyway, so what's another 30, 40 billion? Remember that before this, the total deficit was in the 25 to $30 billion range. So we have to be careful about not loading on a whole bunch of new costs, because then we will have some tax increases and maybe significant ones to pay for that. But for now, I think we're okay on that front, or at least I'm not as worried as some are. Now, interest rates, of course, as I said, are very low on what the government is borrowing, and that's not permanent. And even when you think about your own business planning, you can't count on interest rates staying this low forever. At the short end of the yield curve, if you look at 3-month rates, for example, sure, they're under pretty direct control of the Bank of Canada. And the Bank of Canada has sort of spelled out for us, a reasonable timetable for when those might start to climb. They're essentially saying they can be patient. They want to make sure the economy is well in gear, and they're thinking 2023 to start raising interest rates. And I actually think that timing will be similar or maybe slightly after the Federal Reserve raises US rates. If you listen to the Federal Reserve, they're saying 2024, but we're more optimistic about the post-vaccine recovery. I think they could end up hiking a bit earlier than that. But we've got a couple of years where short-term rates will stay very low. The long end of the yield curve, if you've noticed, we've started to see those yields drifting up. And I expect that will continue over the coming year or two. That by the time we get to late 2022, for example, Government of Canada 10-year yields could be, 80, 90 basis points higher than they are now. So 10-year rates getting pretty close to 1.5%. That's still low by historic standards, but it's not as low as they are now. So, plan for that when you look ahead. Plan for a gradual climb in longer-term borrowing costs in your decision-making. Ultimately, we learned a very important lesson in the last business cycle, is that if you want to look further ahead, where will interest rates be when the economy is well in gear and everything's back to normal? The answer, and this is true internationally, is not as high as they used to be, or even close. Some structural changes in the economy, essentially, have meant that, and this is a global story, the interest rate that a central bank needs to get to cool the economy down when times are good and prevent inflation is simply not as high as it used to be. You know, we might get short-term interest rates up to 2 to 2.5% in the next business cycle. In the last business cycle, the Bank of Canada only took the overnight rate to 1.75%. The US only got its short-term rate up to 2.5%. And for those of us like me who sometimes have amnesia about what the previous decade looked like, I'll just remind you that in the cycle that began after the 1991 recession, eventually short-term interest rates got to 8% in the US and Canada. So it simply doesn't take yields like that to slow the economy down. We demonstrated that in Canada, the US, Europe, the UK, Australia. All of them had interest rate peaks in the last cycle that were much lower than we'd seen in prior cycles. And we believe that the factors behind that, and it's a whole boring speech for me to explain them, but the factors behind that are likely to be still with us in the coming cycle. So yes, interest rates will be higher, but for those of us with some gray hairs and longer memories, not high by historic standards. As I said, I think the Bank of Canada will actually raise interest rates a little bit later than the US Federal Reserve. If you actually look at what financial markets are pricing in, they're pricing in the reverse. They're pricing in the Bank of Canada moving ahead of the US. And I can't see the logic in that for two reasons. One is that our downturn was bigger. Our energy sector was a pretty big lead weight on Newfoundland, on Alberta. And that's a bigger part of our economy than the energy sector is for the US. So we have more to recover. And secondly, I think one thing the Bank of Canada does not want to see is a trend depreciation in the Canadian dollar. What we saw in the last business cycle was we had a very unbalanced expansion. Yes, we managed to get to full employment, but we did so on the back of, I think, an excessive reliance on households doing a lot of borrowing and spending and on the housing market driving growth. We need in the next cycle to not keep mounting on that household indebtedness, and we need to lean a little more on exports for a more balanced recovery. And what we've seen historically is that Canada really doesn't do very well on exports with the Canadian dollar any stronger than it is right now. And in fact, tends to do a little better if dollar Canada is more like 135 to 139. So a Canadian dollar more in the lower part of the 70-cent range. And to get that, one way to get that is to simply lag a little bit behind interest rate hikes when the time comes. So we actually think that the Canadian dollar, if I look at a couple of years, might be on balance a little weaker than it is right now. So in terms of things like capital equipment that you import, a little bit of an extra expense there if the Canadian dollar does start to gradually depreciate. I'm not talking about a huge move here, but at least a little on the cheaper side from where we are now. If I look across Canada, I mentioned the oil sector as one noticeable difference. You know, we like to say that we're all in this together, but in fact, we're all in the same boat, but actually some boats are leaking oil. So if I look at the GDP decline for Canada this year of somewhere around 5.5%, maybe a little bit better than that, Alberta is more like a 7.5% decline. You know, Newfoundland might be 7.5 to 8%. And it really is the troubles in the energy sector that's responsible for that. And, you know, the energy sector might start to enjoy slightly higher oil prices in the coming year. You know, global demand and usage of oil fell like a stone when we stopped driving to work and we stopped flying. And, you know, we do expect that demand to come back. But if I look out a few years, you know, we're not expecting to see a return to $70 or $80 a barrel oil, even in good times, because what we demonstrated in the last cycle was there's a lot of oil supply in the world that's profitable at $70 or $80. And before you get there, some of those other suppliers start to pump out more oil. the US might be handcuffed a little bit more than it was in the last cycle. I think the Biden administration is going to be tougher on climate change and therefore tougher on their energy sector than the Trump administration was. But we're not going to get the same lift that we did in the economy prior to, say, 2014 from $80, $100 a barrel oil. So even when we look ahead to the recovery in Alberta, and it will recover, it's going to take a while to start filling up those empty office towers that you have now. So a bit of a difference across Canada in terms of economic growth. Most of the difference is that the energy provinces are doing a little worse than the country as a whole. Ontario and Quebec are sort of, because they're such a big part of the economy, can't really drift too far from the average because they do make up a lot of that average. Atlantic Canada is actually benefiting from keeping COVID under better control. So they've been keeping the restaurants open and so on. But that said, they tend to be a slower growing region. So basically, that's just sort of narrowing their typical gap to some of the larger provinces. Let me look now at a couple of longer term issues. I mentioned the Biden administration taking over. What does that mean for Canada? By the way, I am calling the election today for Joe Biden. I'm pretty certain he's won. So if you look at what he's promised, he doesn't have a Canada platform, but there are some items in his platform that have raised some alarm bells in Canada as opposed to the Keystone XL pipeline. Not great news for Alberta, but hopefully they can get the one to the West Coast built, solve some of the problem. He's certainly got some issues for us on the trade side. He's talking about ramping up spending on climate change infrastructure. I don't actually think he'll get all that spending because the Republicans in the Senate might block it. But if he does get it, he's promising to spend every penny on stuff that says made in the USA. I don't think he's talking about not buying electricity from Canada. So those of you involved in that, I mean, I do think we're going to get electricity exports and so on. But he's not a complete free trader. But what is positive on the trade side is he does respect multilateral agreements. He wants, in fact, to leverage it's America's allies in Canada and Europe in discussions with thorny issues with China. And as you know, we've had some thorny issues with China that in some sense are a byproduct of the US-China tensions. So if we can ease some of those tensions between the US and China by doing it multilaterally with the US as our partner, perhaps we can do better in terms of our negotiations with China on some of those sticky issues that have also concerned, in some cases, trade retaliations on both sides. So that's a potential plus. But the reality is the biggest thing that Joe Biden can do for Canada is get coronavirus under better control by paying attention to detail and also efficiently manage the rollout of vaccines, because that's, of course, going to get the US economy, our major export market, in gear. Some longer term things to think about post-COVID. You often hear in a crisis like this that the world will never be the same. And usually those predictions are exaggerated. The world often goes back to something closer to normal than you think. I do think that we'll end up back in our offices. So the power demand to keep the lights on in all those high-rise office buildings will be back because the reality is we had offices for a reason. People work better collaboratively. And frankly, I don't really like sitting here in my living room by myself. So I think that office demand will return, but I do think that we'll be left with an overhang of retail space. People were already trending towards online shopping, and some more will have tried it. They won't retain all the share they have now. We will return to try on sweaters in stores again and pick our own tomatoes in the supermarket rather than have them delivered. But nevertheless, online will come out of this with a bigger share than it had going into it. And we're going to be left with some empty retail space that we're going to have to be creative in thinking about. I think that travel will return in earnest. The trend pre-COVID was the world's population was spending more money on travel, more of its income as a percentage on travel. So people are dying to travel again. They're just now not willing to die in order to travel. When COVID's behind us, I think we'll get back to that. And then you can think about other trends like that. And my general answer is just simply think about what was already trending pre-COVID. If COVID has enhanced a certain trend, it's likely to continue. Things like online banking, maybe some things like that. But if this came out of the blue, then that's telling you that consumers and businesses are doing things now that they didn't prefer before and were likely to go back to their old ways before. And with that, I'd like to open it up for questions if you have any.
Terrific. Yeah, and quite a few questions have come in, Avery. Actually, you've answered a lot of them. There's been some questions about the difference for people in Western Canada with the oil and gas sector. There was some questions about what's going to happen to the Bank of Canada and U.S. reserve rates, and and so you've jumped that one. But any thoughts on the impacts on small businesses closing due to the shutdowns?
So this could have been way worse, but it's still not great. So I say could have been way worse because we've now got a rental subsidy program that looks a little better than the first one we had. That's going to help. There were wage subsidies for businesses that could at least stay partly open and therefore needed workers. Not a big help if you're closed. You don't need workers, so subsidizing wages isn't going to help you. And I think the reality is that because we still have another, say, 6 months to go of running around wearing masks and not doing this and not doing that, we're not through the story of business closures. So unfortunately, we're going to come out of this with a lot of empty storefronts, a lot of restaurants. Some of our favorites might have closed. I do think that the reality of that sector is that if you think of a typical recession, what you've often had is big factory closures. And you don't get those back very quickly. Someone else doesn't come along and build a new steel mill to replace the one that was disassembled and shipped away. That's not as true for restaurants, for example. It doesn't take long if there's an empty store to rent for someone to buy used restaurant equipment, and it'll be there with abundance to meet the demand that will surge again for eating in restaurants. So we will have to recreate in some of these sectors. Might not take forever, but I do think it's a fair thing to say that we have not seen the worst of that. In retailing, what you often see is stores don't go out of business in the Christmas period. They go out of business right after the Christmas period. So I think we'll see some further, for example, retail closures in January and February.
So, again, as I say, I think you've answered most of these questions. I'm cognizant of time. So I did want to just finish with one, and you did touch on this, but if you can kind of encapsulate it, your overall assessment of the federal government's current fiscal position. So not a big concern at this stage because rates are low, but the issue is whether or not it results in programs that become permanent as opposed to temporary.
Yeah, I think we need two things. And the finance minister is presenting a mid-year update. And for all I know, the number is now 400 billion or 420 billion. I'm actually not concerned about that 1 year number.
Okay.
What I'm concerned about is watching to make sure that we don't get used to this, that the target should be something like getting deficits back to 30 or 40 billion, or at least 30, somewhere in that range in 2-3 years out. And most of that will happen on its own if we don't load on a lot of new spending. What I'd like is some assurance from the minister that we have a target, even if we don't have a date, an exact plan of how we're going to get there. And I don't think we're going to get that on Monday. But I'd like to see a target set, for example, on something like what percentage of federal revenue or how many or GDP interest costs on federal debt are going to allow to be. If you go back to when we got in big trouble, towards just when Jean Chrétien took office and really had to pummel us with a lot of spending cuts, we were in trouble then, not just because debt to GDP was high, but because interest as a share of GDP or as a share of government revenue was huge. And the good news is that before the pandemic hit, interest on federal debt as a share of GDP was the lowest it had been in our lifetimes. So I have data going all the way back to 1955. Maybe there's someone who was around in 1935 who could tell me something different, but it's never been lower than it was just before this pandemic. So we had room. We're nowhere near where we were, in other words, in the early 1980s, but we can't go there. We have to make sure that we put a cap on how many tax dollars are going to pay interest as opposed to provide us programs because no one wins when that gets high. The people who want government programs don't win because too much of the tax revenue goes to pay interest. And the people who don't like big tax bills don't win because you end up as part of the solution having to raise taxes a lot just to pay interest.
So when you said a shot in the arm, you really meant a shot in the arm, not a change to our diet going forward.
That's right. I think that we hopefully can get we can keep government appropriately sized in terms of thinking about longer term programs. It's not to say that there aren't good, useful, longer term initiatives for governments to take, including some related to infrastructure, but we have to budget those within a reasonable sized government for the pre-pandemic size of government, not where we are now.
Avery, thank you for taking the time. I really do appreciate your insights. It's always a pleasure to get a sense from you in terms of where you think things are going. We really do appreciate you taking the time.
My pleasure.